Hello everyone, Lucas here from ThePropGuide. Today we're going to be talking about the rising interest rates in Singapore. Full disclaimer, this is not financial advice, just my personal opinions. The ideas here are just for reference and educational purposes only. Right, so in theory, as the bank loan interest rates rises, buyers may find it more unaffordable if all else stays the same. Property prices should then slow down or drop as demand will be dampened with the rising costs, as well as sellers who are unable to service their loans because of the increase in interest rates may have to fire sale their units. Let's take a look at some past trends to see how it plays out. Based on what I see, only during recessions when we really see strong property price movement downwards. Captain Obvious, I know, right? But we do see property prices rising as well despite climbing interest rates. We can skip the next section if you don't want to see the charts. Asian financial crisis, July 1997 to December 98. Interest rates went up from sub 4% to 8% at the peak of 1998, and property prices have been on a downtrend despite interest rates tapering off to a 2% by the end of it. Dot-com bust, March to November 01. Interest rates rose from 2% to 2.4% by August 01 and took a nosedive to 1.2%, and property prices didn't really rebound despite almost seeing half the interest rates at 1%. So you see the power of recession. And after that, to 2005, we saw a steady decline in property prices. However, you look at 06 to right before the global financial crisis hit, despite the rising interest rates, property prices shot up. And once global financial crisis hit, December 07 to June 09, we observed that the price went down along with the interest rates. Post 09, the market recovered and prices reached an all-time high at end of 2013 when the interest rates continued staying relatively low. Then on 2013, the government introduced additional cooling measures and price went down steadily till 2018. From 2018, we can also see property prices steadily rise despite climbing interest rates till 2020. And when interest rates drop to 0.5%, the bull is back. So what can we learn from this? Low interest rates doesn't automatically mean the property price will increase, especially during recession. And we must also adopt a long-term view, and you must have holding power to hold through if there's any recession. Let's understand the other forces of Singapore real estate market. Number one is the ownership type. As 88.9% of the property owned in Singapore is owner-occupied, meaning we buy to stay in, and most wouldn't just sell their own home because of a few percentage increase in interest rates. Otherwise, they would have lived on the streets. Those who are most likely to get impacted first will be the ones who invest in pure investment properties and that they are unable to get the tenants to help them service the loan. And if selling happens, that will cause dips in the price. But then again, right now there has been a supply crunch for rental, and rental prices have been going up in the past 16 months. Number two, Singapore's thermostat, the government. They can cool down the market or turn up the heat with their policies to a certain extent. Since 2010, seller stamp duty has been in place to restrict speculative activity, thus reducing supply pressure. Instant flippers, as well as the TDSR from 2013 has reduced over-leveraging for the buyers, thus limiting the potential for loan defaults. Here's a snippet from our Minister Lawrence Wong during May 2019 regarding property policies. Number three, Singapore's current economy and demographics. We have been experiencing strong economic growth, increasing monthly wages, and we also have highly skilled expats coming in as well, driving demand. HDB resale prices have also shot up these 2-3 years, resulting in many sellers using the profits to upgrade to private properties. Demographics also shift towards more singles. They are owning their own homes as well, further increasing the demand for housing. So as long as low unemployment rates continue and salary continues to grow, it is unlikely that we'll see a crash in property prices based purely on the rising interest rates. And if you currently own a property and you're concerned about the increasing interest rates, you may consider to find a mortgage consultant to see if refinancing or repricing makes sense for you. I also have clients who choose to sell now, rent a place or stay with their parents, and buy the dip when it comes. It really depends on your own investment strategy, personal circumstances, and risk tolerance. What is your investment strategy? Let me know down below. However, the main group of people that could be concerned are likely the singles under 35 who are on the fence on buying their first property. For this group, private property could get increasingly unaffordable. With a heavy down payment of 25% plus 4% buyer stamp duty and climbing mortgage rates, at this time, property prices could still climb and their incomes may not rise fast enough to cope with the higher prices. So what should we do? Do stay tuned for part 2 where I share 3 key considerations on buy now or wait. Hope this helps. Thank you for watching.